Okay, in this chapter, let's look at stochastic indicators. Now, these are one of the key momentum indicators that we need to be aware of. Again, same as before, what are the rules of interpretation? Now, we want to avoid the classic textbook rules when we're trading, but we need to be aware of them for our background. Now, overbought and oversold, similar to the MACD, same principles here, crossover, and I'll show you examples of this in a second, which again give buy and sell examples, and divergences. The raw stochastic is computed as the position of today's close as a percentage of the range established by the highest high and the lowest low of the time period you use. So again, as I mentioned, what they're doing is they're comparing where the price closed today compared to the range of price ranges it's been, and that gives us some indication of momentum, because of course if momentum is strong, then it should be near the top of the range. If it is weak, it would be closer to the bottom of the range. The raw stochastic %K, now there's two lines with stochastics, just to make the jargon that much more difficult, annoying and bland. One of them is called unimaginatively %K, which is then smoothed exponentially to yield the %D value. These calculations produce the original or fast stochastics. Okay, let me explain that, or try and explain it in more technical terms before I get into plain English. The percentage K is worked out according to a formula like this. That's where C is the latest close, L5 is the lowest low for the last 5 days, and H5 is the highest high for the same 5 days. Yeah, so that's your percentage K up to that point. And basically what you're working out is where is today's close in relation to those expressed as a percentage. %D then takes the value and works it out according to a formula like this, where H3 is the 3-day sum of that, and L3 is the 3-day sum of the difference between the high and the low. Yeah, so that's what's called, it smooths out some of these sharp moves into more gradual moves. So you've got two lines, as you will see. You'll have sharp moves, or the fast stochastic, and you'll have a slightly slower line there, which is the %D. It's in combination that we interpret these according to overbought, crossover and divergence signals. I know that sounds really complicated, boring and dull. Let me tell you what you need to know. First of all, you need to know the rules of interpretations used by professional traders, which we're going to go through and show examples of. You need to know some of the background, which we've given a little bit here. You also need to know the pitfalls of such an indicator in practical terms, which we'll go through as well. What you don't need to know is memorizing this formula. You don't need to do that. And you don't need to know the minutiae of what happens if a particular element here changes and there changes and so forth and so on. Basically, the bits you need to know I'm going to go through in the next chapters.